Have you ever felt the fear or sting of a stock you've invested in crashing? Or wondered how you can protect your hard-earned money from the unpredictable ups and downs of the stock market? The traditional solution to this problem can be described in one word: diversification. So what is diversification in stocks and why is it so crucial? Stick around and by the end of this video, you'll know how to think about diversification for your stock portfolio like a pro. Hi, I'm Noah Davidson with the Cashflow Academy, and over the past 2 decades, I have taught tens of thousands of people and helped them learn how to navigate the financial markets and build stock portfolios and learn how to protect those investments so that they can weather any storm that the market might bring. As a seasoned financial educator and independent investor and trader, I'm here to help you break down complex financial concepts and make them simple and fun and actionable so that you can take these strategies and apply them in the real world. Now, today we're talking about one of the most important tools in your investing arsenal: diversification. Diversification can be a big deal because it's all about spreading your investment dollars across different stocks in different parts of the economy, in different sectors and industry groups, and even countries. Think of it as not putting all of your eggs in one basket. Why? Because if one stock tanks, it won't drag your entire portfolio down with it. Diversifying makes your investments safer and more stable. In today's video, we're breaking down what it means to diversify your stock portfolio, why seasoned investors swear by it, and by the end, a simple strategy you can use to start diversifying right away. And trust me, you'll want to watch until the end because understanding this one concept can help you level up your investing game forever. Diversification means spreading your money across different investments to reduce risk. Instead of relying on just 1 or 2 stocks, you're building a portfolio that includes multiple companies from different sectors and even asset classes. It's about balance. Some investments might be risky, but others will act as stabilizers. Markets are unpredictable. One day, tech stocks are booming, and the next day, energy stocks are taking the lead. Diversification helps manage this uncertainty. If one sector takes a hit, others in your portfolio might be rising, evening things out. Historical data even shows diversified portfolios tend to perform better in the long run, reducing risk while maintaining steady returns. Now let's get practical. Here's how you can diversify effectively. The first thing you can do is mix sectors. Invest in different industries. Tech, for example, healthcare, energy. Don't go all in on just one sector or just one stock. Use exchange-traded funds. Exchange-traded funds give you exposure to multiple stocks in one investment. For example, an S&P 500 exchange-traded fund, the SPY or the VOO, spreads your money across 500 of the biggest companies in the U.S., giving you automatic diversification. In fact, if you check out the SPY, the holdings, you can see how it's broken down by sector. Take a look at this graphic here. We can see that the SPY is heavily invested in technology. About 27.5% of that portfolio is in tech, which is good because we live in a technologically driven economy. But it's also diversified about 13.4% in healthcare, and it's got about 11% in the financial sector. And we've got 10% of the portfolio in consumer discretionary spending. Now, discretionary spending is wants, things that we like to buy that we can choose to buy from time to time. We also have a good percentage in communication services, and this is the media. This is social media, streaming content, your carriers, and that's important because that's the backbone of the economy. And then you've got 8% in industrials, and you got 6.8% in consumer staples. Now, consumer staples are the things we buy all the time, our groceries, our gas, things of that nature. And then we got 4% in energy, 3% in utilities, 2.8% in real estate, and 2% in basic materials. And that right there is an automatically diversified portfolio, again, based off of the S&P 500 holdings. And if you look at the companies in that of those 500 and how they have them weighted, let's take a look at the top 10 holdings of the SPY, and you can see how these companies fit. Apple Incorporated is one of the top 10 holdings of the SPY. You'll also see Microsoft in that mix, followed by Amazon, Nvidia Corporation, and then Alphabet A shares and Alphabet C shares, and that's Google. And everybody's familiar with Google. You've got 6% in Tesla, Meta, that's old Facebook, of course, and then you've got Berkshire Hathaway, which is also diversified across a wide variety of investments. In fact, a fun exercise to see what a diversified portfolio can look like is to look up the Berkshire Hathaway holdings, and you can see how Warren Buffett and his experts have structured the Berkshire Hathaway portfolio, and that's a phenomenal example for you. And then last but not least, you got a bunch of shares tied up in United Health Group, which gives you exposure to that healthcare industry. So that's an excellent example of automatic diversification using exchange-traded funds. You can also go through and select exchange-traded funds by sector. If you're interested in investing a little bit more heavily in energy, because of the current energy policy, for example, you could select the XLE exchange-traded fund that focuses on energy. Or if you thought there was going to be a building boom and you wanted to invest in basic materials, you could invest in the XLB, which focuses on all the companies that help deliver those basic materials for manufacturing and industrial activity. If you thought industrials were going to take off, you could invest in the XLI. There's an exchange-traded fund for just about every sector in the economy. And if you wanted to work through and identify what part of the markets are performing well, one of the techniques that professional fund managers will use is called sector rotation. And you can follow the money in the markets and see where the big investing dollars are going. You might, for example, occasionally see money coming out of industrial stocks and going into energy stocks. Or you might see money being funneled from healthcare into technology, or vice versa. Following the sectors and which sectors are performing hot can potentially help you outperform the broader market, but it also gives you a clue as to where the smart money is going, and you can see what parts of the economy are performing best. The third piece of practical advice is to think globally. Don't just stick to U.S. stocks. Consider international markets for additional layers of diversification. And the fourth practical strategy is to add other assets. Stocks are great, but diversifying into different asset classes is the truest form of diversification. Diversifying your portfolio and putting some money into the bond market, for example, by investing in bonds, or investing in real estate, buying rental properties, or participating in real estate syndicates can be a great way to diversify your asset classes. You can invest in commodities, you can buy precious metals, you can invest in commodities in other ways, and that's a great way for you to reduce your risk overall. And again, give your portfolio exposure to these other asset classes for safety and stability. Now let's talk real for a moment. There are issues with diversification among stocks. One of the challenges in the financial markets these days is that the stock market itself, because of the way the broad market indexes are structured and automatically already diversified, there's a really high rate of correlation within stocks themselves. Probably around an 80% correlation rate, where if the market's up one week, the vast majority of stocks will be up that week. If the market's down that week, the vast majority of stocks will also be down that week. So the high rate of correlation within the stock market itself creates a challenge for diversification. And again, the best way to defend against that is to learn how to invest in different asset classes, not just in paper assets. Now, there is a secret to protecting your portfolio that you can use that will really help you get ahead of the game, protect you in the event of a down market, help you cover your assets, and allow you to weather any storm. And that secret is called portfolio insurance. You can invest in a well-diversified portfolio of stocks and ETFs, but at the end of the day, if you know how to insure that portfolio against downward market moves, the simplest way to do that is through protective put options, or you might be able to use futures contracts to help you hedge the downside. But portfolio insurance is one of the best kept secrets that really help people protect their wealth and grow it more efficiently. Because if you can avoid the downside of the market, when the market's performing well, you're compounding and growing even faster. So if you're ready to build a portfolio that weathers any storm, one of the easiest ways to diversify is by investing in ETFs that automatically have that diversification built in. I've got a whole video for you breaking down ETF investing. Just click right here and watch it next. And if you found this video helpful, make sure to like this video, subscribe to the channel, and hit that notification bell so that you don't miss what's coming next.